Welcome, everyone. I'm Angelo Robles to the Angelo Robles Podcast. I'm also the founder and CEO at Family Office Association. We're in for a special treat tonight as we have a return visit. Adam Robinson, investment advisor to among the world's largest hedge funds and single-family offices. Of course, per that title, it could only feature the one and only Adam Robinson. Adam is an investment markets maverick, capitalizing on his lifelong study of thinking and the human mind. His proprietary methodology, anticipating global financial trends and changes across all asset classes with an uncanny precedence, has made him the trusted personal investment advisor to the heads and chief CIOs of among the world's largest hedge funds and ultra high net worth family offices. Adam, it's so good to see you. Welcome back.
Always great.
Well, thank you. We had you on early during COVID, approximately around the 1st of April. We're now early in 2021. And still some more of the same and some things have changed. Adam is amazing, but I do think there are going to be certain things that we do need to be maybe arguably a little bit repetitive of some of the things we covered, but there could be a new twist on it. And I probably only have about 30 or 40 new questions as well. So our audience that loves Adam and he has a big...
That's you.
Oh, yeah. Well, no, it's not just me, Adam. It's like everyone who's on the call or video now. It's really exciting. So economists, macro thinkers, and investment strategists are a copulation of their critical thinking, education, and experiences, and focus their advice, assuming they're not just college professors, and nothing wrong with that, around data and available resources. My question to you are, what key economic indicators, data, resources are important to you to put the investment puzzle together?
None.
Ooh.
Yeah.
So like what do you use as a macro thinker?
Yeah. So I reduced the world down to as few variables as possible. And by few, I mean, I try to get it down to under 3, and sometimes I can get it down to 1. And so, for example, the 10-year yield. And once you know the direction of a few key variables, you can deduce everything else from sector allocation to relative performance of countries even, and foreign exchange, commodities, bonds, all of it. And so if someone said, and I've told people this, people, I mean your audience, on prior podcasts, if I had to look at 3 things, it would be the ratio of copper divided by gold, which is a leading indicator for 10-year yields. I would look at the investment grade credit spread. So if you're using ETFs, long LQD, short IEF, and I would look at the relative performance of consumer discretionary, that's XLY, divided by XLP. So long discretionary, short staples. And that'll give you a snapshot on where 10-year yields are headed, what bond traders think, and the state of consumer spending in the country. And I say those 3 things. When you go to a doctor's office, they take your blood pressure, they look in your ear, they check your eyes sometimes, and they have that little rubber mallet and they check your reflexes. And those 3 things give them a snapshot of what your body's doing right now. And so similarly, those 3 indicators, and I've mentioned them before, are, if I were flying by instruments, pilots, when they're instrument certified, you don't even have to look out the window. You just fly the plane by the instruments. So those would be the 3 readings I'd want to take.
Adam, that's excellent. I mean, the last one we did, I had a little bit more of a buildup to it. It probably took about an hour. So in the first 3 minutes, we get to the big 3 indicators. I was going to say, as I've been more active in investing and looking at the bigger macro picture, the 10-year yield, the dollar, and oil. And we're going to get to the dollar and oil and some other indicators, gold, et cetera, a little bit later. But I love your three. It reminds me, the copper divided by gold. I remembered you put that in my head about 4 years ago at one of my live physical events. But the other two, I kind of forgot a little bit. I would like to go back to that. So one, thank you so much for hopefully making me a better investor.
Sure.
Leading into that, why don't we take maybe a little bit of a step back, because you're such a, to me at least, and others, a special person to have on. To you, what is critical thinking?
Oh, golly. That's a tough one. For example, we often hear, check your assumptions, don't assume anything. But that's much harder said, so it's much easier said than done. After all, when you're assuming things, you don't realize what you're assuming or what your blind spots are. So critical thinking is, there's a better word than critical thinking, which is this: seeing what's going on, simply seeing. And that's much harder to do than people realize. They think they know what's going on in the world, but they don't. And they have preconceptions that blind them to the way the world is behaving. And I think I mentioned this back in April, our last conversation. In November of 2019, November 6th of 2019, Ray Dalio said in a blog piece entitled, "The world has gone mad and the system is broken." The world has gone mad and the system is broken. And by that he meant the world that he saw did not line up with his model of the world. So he said, the world has gone mad. Well, the world is never mad. The world makes perfect, don't seem to make sense. It's your model of the world that's out of line. And I'll tell you something, just when you thought, we were getting our heads around, negative interest rates, we're in a world, this was just after our early April conversation. Mm-hmm. I believe it was April 23rd, the price of oil went negative. It closed at negative $36.73. So if you, Angelo, had empty barrel, you'd get paid $36.73 to take oil off their hands. And so given that that's the world, given this is truly Angelo and Adam in Wonderland, right? This is really Wonderland territory. Then all prior models of the world have to be completely reevaluated. And so that take that into account, because the world always makes sense. So if things seem strange, it's your model of the world that's not lining up. So I think critical thinking is seeing what's going on and then adjusting your model of the world to account for what you see, instead of dismissing it as, oh, that just doesn't make any sense.
How difficult is seeing the world as it does adapt so frequently, especially now? Is that something that is taught? Do we read about it? Do we hear about it? Do we have a mentor, or do we learn the hard way?
Well, I think, it's interesting. Anyone who's successful in their domain is a critical thinker. That's how they got to be successful, right? So within a domain, and it doesn't matter whether the domain is gymnastics or chess or investing or a real estate empire. You built that up because you thought critically about the world around your domain and about yourself, right? And you had to deal with yourself and your performance objectively and critically. And when things weren't going well, you adjusted, right? And so we do that within domains. It's harder to do it just generally, but all of us are critical thinkers within our domains. And so that's how we got to where we got in life, right? Angelo, you're successful with your family office association. So you had to think critically about providing services and value to your family members. And that's true with me in my work in predicting global markets is I get feedback every day, every second. I've got to reevaluate that hypothesis. Incorrect. And I say that because, our corporate and political leaders don't always see clearly. And actually in this world, they're thinking and seeing not too well at all, because everything is a state of emergency. So they're in the stupid zone. And so, yeah.
Yes, we most certainly are. How do you avoid confirmation and other biases that probably is inherent in all of us?
That's such an excellent question. I think confirmation bias is one of the greatest impediments to seeing clearly. And so the way to do it is to set yourself up for anti-confirmation bias. In other words, what would I need to see to tell me I was wrong? As opposed to, oh yeah, there's more evidence that I'm right. And you have to be careful about the internet and research, because the more information you have, unless you begin with the starting question, what would I need to see to know I'm mistaken about any conclusion? The more information you gather, the more embedded you will be in whatever your bias was. And I use the example of Paul Slovik's 1974 horse handicapper study. I discussed that, I think, with your members before, or
and I want to hear it again. It's amazing. Please share it.
Okay. So in 1974, Paul Slovik, and this study is taught, it's in the CIA training manuals. It should be taught at every business school. And this is the study. In 1974, Paul Slovik, world-class psychologist, right? If they gave out Nobels in psychology, he should get one. He's that good. Like Daniel Kahneman.
Sure.
He's buddies with Daniel Kahneman, right? That's his level. So in 1974, he gathered 8 professional horse handicappers in a room around a table. And he said, I want to see how good you guys are. And he said, I'm going to give you data on horse races, and you guys are going to predict the winner. And these are races that have been run in the past. So I know the outcome. And I'm only going to give you the data. You're not going to know the horse's name. You're not going to know the racetracks. You're not going to know the dates, but I'll give you all the statistics. And in round 1, I'm going to give you any 5 pieces of information you want. And in round 2, I'm going to give you 10 pieces of information. In round 3, 20, and in round 4, 40 pieces of information, whatever you want. So John over there, if you want the weight of the jockey, if that's your first piece, good, I'm going to give you the weight of the jockey. And Angelo, you might want the quarter-mile sprint time of the horses, or the weight or the age of the horse, whatever it is, you were going to get that information. And there were an average of 10 horses in every race. And the study was fascinating. Now, mind you, these are guys who make their living betting horses. So they are very good at what they do. And so I alluded earlier, they're critical thinkers about horse racing. So in the first round, with only 5 pieces of information, they were, hold on, I got to do this from memory, 17% accurate. And there were 10 horses in every race. So you would expect 10% accuracy just by blind chance, right? 1 in 10. Like you just close your eyes, one of the horses is going to win, right? So they were 70% better than chance. That's excellent.
Tremendous.
It's quite good, right? It's almost double. Like that's very good. You're going to get rich if you know how to calibrate around your confidence. Now, their confidence, he asked also, in addition to predicting the winner of the race, how confident are you in your bet? So scale of, obviously the low would be 10% because that's just blind luck. You know, you're starting with 10%. And perfect certainty, like Secretariat, it's gonna win, would be a certainty of 1, right? And they were 19% accurate. Sorry, 19% confident. So their confidence and their accuracy perfectly lined up. 17% accurate, 19% confident. Now that's what psychologists call very well calibrated. So they were exactly as confident in their judgment as the statistics proved them to be. So for example, when a meteorologist says there's a 30% chance of rain today, what he or she means is this: if you list all the days where I said there was going to be a 30% chance of rain, you'll see that on those days, 30% of them it rained. 70% it didn't. So again, with 5 pieces of information, they were 17% accurate and 19% confident. Total alignment. In round 4, with 40 pieces of information, that's a lot more information. Their accuracy was still exactly 17%. They were no more accurate, but their confidence had shot up to 31%. They were almost double the confidence that they had with only 5 pieces of information. Now they're very badly calibrated around their judgment. So confirmation bias, what they were doing is the more information they got, they were just more sure that this horse or that was going to win when they shouldn't have been more sure. So beware the dangers of too much information. And so the way to combat confirmation bias, Angelo, is such a brilliant question, is, and it's a question that I use daily, is what would you need to see to change your view? So when my clients, if I say interest rates are headed lower, then my clients would say, well, actually, before they even say it, I say, and I will know that that view is wrong if we see copper versus gold go higher. But until we do, interest rates are headed lower. That's our position. So that's the way to fight confirmation bias, which goes to your earlier question about critical thinking.
Yes, and goes to my earlier question about key indicators and why you keep it, quote unquote, relatively simple. I suppose a question I'll have for you, we both know gigantic hedge funds with various analysts, and they subscribe to gazillion services, and they look at reams and reams of data. And I'm not talking about the renaissances and organizations like that, just a regular long short fund. So they have too much information from what you're saying coming at them.
Well, yes. So again, what you want to do in any domain is to reduce it down to a few variables that you can follow and think about. You know, if I see a report by this investment bank or that, I'm not going to name any, but you'll see reports that are like 50 pages long on why you should short oil or whatever the investment thesis is. And really, if it takes 50 pages to explain the thesis, well, you can't even actually give me an argument. That's what I call making the case. So what they do is they throw lots of facts and statistics. They make the case that oil's going down or going up or whatever. But that's not an argument, because you wouldn't know how to answer the question, what would you need to see to tell you that you were wrong? So when an investment advisor tells you to put 10% of your portfolio in Bitcoin, then the question to ask that advisor is, thank you so much. What would you need to see to tell me that you were wrong, that you should not have 10%?
Now, Adam, if I may go into that one a little bit, how about the advisor that says, I think you should put 0 into Bitcoin? Should I ask them the same question from the other perspective?
What would you need to know to tell you that you were wrong, that you should have piled up into Bitcoin? It's a question to ask yourself, and not just in investing, in anything, right? You're real estate, and you're thinking of, now's a good time to pick up commercial real estate because everyone is, thinks office buildings are dead forever. Well, what would you need to see to tell you that you were mistaken, that it's not time to buy office real estate yet. So it applies also to any domain, really almost any decision.
I think my next two questions are related to the answer you gave, but there may be little nuances, so I'm going to ask them anyway. How do you think through tons of information? I guess the answer is you don't get tons of information. And better said, how do you interact with the information that you have? How do you think through the probabilities?
So again, the trouble with too much information is that that's a tautology. Too much information is, of course, too much, but we readily get to too much information. I have a hard time really thinking, by thinking, I mean reasoning with more than a few data points. Really, it's about all I can manage in my Cocoa Puff brain. And I can reason very well with that. And by the way, if you look at all of the statements over the years of Charlie Munger and Warren Buffett, everything they said is always really simple. And, Charlie Munger once said, Warren and I have never used spreadsheets or discounted, cash flow and all this. Because if the decision weren't super clear that this was a screaming buy, then a spreadsheet's not going to change their opinion one way or the other, right? It's either a screaming buy or it's not. And if you have to do decimal place analysis on models that are full of assumptions, you're already in trouble, right? And so the thing to do is to keep whatever information you have to a minimum that you can think clearly with. And beyond
and would you define that as having a mental model, a process that you follow to get to your outcomes?
Yes. And then you will always check that model, right? Like I expect certain things to happen in the world. And I have already preset markers. So for example, I expect copper divided by gold. Those three indicators, by the way, that I mentioned earlier, they're leading indicators. It's not just they tell me how things are going, they tell me how they will go, which is even more important, right? I don't want to just know where 10-year yields are today. I want to know where they're going to be in 6 months. And so that's always what we're trying to do, right? Assess the future. And it's a question of probabilities. And really the key thing is, I think this is greatly underappreciated, is just calibrating correctly around risk. Just calibrating correctly around risk. By the way, and again, Buffett and Munger, my two favorite philosophers, one of the risks is that you were mistaken, that your reasoning was incorrect, right? And so, I'm a chess master, which I say only because I know the game very well. And one of the things great chess players are always doing is what happened? Like you always factor in what if my analysis of this combination, this 10-move combination, what if there's a flaw on move 9, right? So you're always calibrating around risk and the possibility that you're mistaken. And that's a key thing, the possibility that you're mistaken. And to always work that into your reasoning. It figures prominently in Buffett and Munger's everything they've ever said. Right?
I asked the question, with all due respect, you were very kind with sharing 3 of your leading data points, as I'll call it, that you look at, and you're very open with me and my audience. You have hedge funds and families that pay you significant money, and you're well worth it. I know it's more complicated than Angelo. I'm sharing these 3. In theory, they could all do that internally. Why does that become hard for them when in theory they could take some of your strategies and implement it themselves?
Well, because it takes years or decades of discipline to do just that and nothing else. Warren Buffett and Charlie Munger have told everybody, this is how we invest. This is exactly how we do it. You could do
very few do it like that.
Just follow it, but it takes discipline. And the thing is, even though I tell people this, they go, wow, that's great. Thanks so much, Adam. We'll add that to all the other things we're looking at. And I'm saying, well, you can do that, but then why would you do that? Those three things tell you everything. Why would you look at anything else, really? And so it takes discipline in your analysis. Now, by the way, I'm talking about those three things from a macro view.
Mm-hmm.
You know, if you wanted to decide whether any given company was a great deal, you'd have to dig in and, you know, should you buy it or short it or whatever, or just avoid it altogether. And you know, that's another thing is to, and again, to cite my favorite philosopher, Buffett, he talks about fat pitches, right? And you wait for opportunities where everything lines up, and then you swing for the fences, right? And so a lot of the discipline in what they do is waiting, really patiently, not doing anything until everything lines up, and then you swing for the fences. And takes
Adam, I'm going to reverse the question on you a little bit. What would cause you to feel differently about your three key leading indicators and take a different approach?
Well, so I might shift to another indicator or two. And by the way, those are my top three, but there are others I use, of course. But not a whole lot more, not a whole lot more. Fewer than 2 dozen for everything in the world. Interest rates, currencies, bonds, interest rates, bonds, commodities, currencies, and equities, including sector performance. Really, just a handful of data points, and I can tell you what's going to happen. By the way, not what I think is going to happen, but what the market thinks is going to happen, like the probabilities. So for example, I know that when metal traders and bond traders disagree about the direction of interest rates, I know that the metal traders are right because they've been right, batting 1,000 for the last 15 years. I don't want to bet against them. So when you said what would cause me to change, well, let's say they were wrong in this particular instance. I go, oh, that's the first time they've been wrong in 15 years. Why was that? And if I can't find an explanation, maybe I go, well, they're not quite as, as infallible as I thought they were. So I'd calibrate around the particular indicator that I was using. I just recalibrate around it.
This probably relates more to poker than chess, but how do you make decisions when you have incomplete information?
Well, that's the thing. Chess is always a bad analogy for markets. Poker is a much better one,
because
right?
we see everything, right?
It's a game of probabilities. We don't see everything, right? And we're trying to calculate in our head, what's the probability that he's going to draw a flush or whatever, right? And so you can make mistakes. Chess, I don't know what you're thinking, but the board is right in front of us. There's no denying what we see in front of us.
We have the same information.
Right. The other difference in the real world versus chess, and actually all sports analogies are flawed in terms of markets in this key respect. The rules in the world are always changing. So for example, sometimes interest rates going down is good. Sometimes it's bad. And knowing that when that's true, which regime you're in, it's important to know that. So it's not like I'll just master these set of rules and then I won't have to think about it ever again. No, the markets continually adapt, continually. And so you have to stay on top of your game. You always have to check, is this indicator still working? Is my analysis correct? You have to be vigilant, eternally vigilant.
And Adam, for those that don't know, in your younger years, I believe your teen years, you did training or some level of a protege under what some people will consider the greatest chess player ever. That's Bobby Fischer. What's the most memorable lesson you learned from Bobby Fischer?
Boy, that's a really interesting question. So I knew him in the 2 years leading up to his winning the world championship. And I got to spend a couple weeks with him at Grossinger's, which was an old
sure. Catskills, New York.
Right? Like anyone who ever saw the movie Dirty Dancing, like they had all these resorts, and he was training for the Spassky match. This was in April, May of 1972. Yeah. And boy, there were so many things. I think that's another thing about Fischer is he was very simple in his analysis, really simple. And boy, it's hard to, I remember once we were arguing over, we had a quarter between us and we were at a diner and we got into an argument about what we should spend the quarter on the jukebox. And we both like Motown. And we were arguing about which songs to play with our quarter. We had dollar bills, but we had only one quarter for the jukebox. And I remember his saying, you know, Adam, you're probably learning about chess right now because you can't separate my ideas about music from my ideas about chess. So that was really memorable. You know, I was all of 16. I thought, wow, that's a pretty heavy statement he just laid on me. That's really fascinating. So, you know, and by the way, even with Fischer, he knew this. In chess, we learn what kinds of situations we play well and which not so well. And we steer the game to the positions we play well in. And that's true in life, right? Stick to, that is a principle. Stick to situations that you're really good at and, you know, press your advantage there where you have an edge. Know where your edge lies in the world. And then, you know, Buffett and Munger, they talk about the circle of competence. Know your circle of competence. It's probably much smaller than you think. And at the highest levels, it's got to be small because you're up against other world-class competitors. So
I don't want to get too distracted by chess, but I will. In traditional chess, again, we all have the same information in front of us and we have to follow rules in terms of how we move. There is something called Fischer random chess, where that back line is shuffled and you can't memorize opens, which is common for chess greats until the game gets more intense about midway through. Do you enjoy Fischer random chess, and is that more realistic to real life? Still not a perfect example.
It's not. It's not, because the beauty of chess is to see how a chess player solves a problem on the board. And the more interesting question, because your audience members may not be familiar with Fischer random, essentially the pieces are randomized, so you can't rely on opening theory.
Right.
The more interesting development in chess that's relevant to the real world is the development of AlphaZero chess. I'm going to explain that because it's relevant to everything you do, whether you're interested in chess or not. So the chess in its modern form has been played for about 1,000 years. And over that 1,000 years, a lot of pretty smart people have played a lot of games of chess and developed theory about how to play the game, what kind of openings are good and bad, and rules, let's call them heuristics, rules of thumb about the game. And so to put this so people have a way to appreciate this, the reigning world champion is Magnus Carlsen, and his chess rating is about 2,900. I'm going to say that's an IQ of 200. Okay, just so people have a reference point.
It's off the charts.
Magnus Carlsen has a chess rating with IQ version of 200. The best chess software up till a few years ago had a chess IQ of about 240, much better than Magnus Carlsen, would crush him. But that chess software had been trained on the best human games, right? So the software was trained on human games. Then Google decided through DeepMind, one of its subsidiaries, what if we didn't give a computer any human games? What if we just let a computer play itself? And so that's what they did. They gave it the rules of the game. That's it. And in 4 hours, AlphaZero Chess had leapfrogged all existing human knowledge of the game in 4 hours because it played millions of games with itself, each time getting better. Now, the fascinating thing, this is the punchline. The fascinating thing is that it recreated all existing human knowledge of the game. Human beings aren't stupid. We're pretty smart. But then it discovered a lot of things that human beings had never thought about because of our limited thinking capacity. And so when you watch, they're called, AlphaZero Chess is the biggest name. And in a 100 game match with the world champion, if the world champion ever played it, he never would. He would essentially lose, 95 games and maybe get 5 draws. Maybe. He'd be that lucky. And so it plays like human beings, but then it plays like alien chess. You go, oh, that's like the dumbest move I've ever seen. And 2 moves later, checkmate. You go, oh, how did it do that? I say this because AI in a new domain, if you just leave it to itself with no preconceptions, is going to discover things human beings had never thought of. Now imagine when that's true in finance or economics or physics, right? So AI is untrained on human preconceptions about the world. It's going to lead to incredible breakthroughs in medicine, in all domains. In all domains. It's really remarkable.
Could I be a little negative and say in the world of finance, then whoever controls a deep mind is going to have such a big edge? It's almost unfair.
Yeah, that's exactly true. And the way to think about it is AI will remove virtually all investment possibilities in terms of equities and such, because you'll get a bunch of computers that are know everything and don't have confirmation bias, trading against each other. Now, one of them might be a little better than all the others, and then it would siphon off all the money until the others learned its strategies.
Do you think we'll see this in 5 or 10 years?
Not 5 or 10, but in 20 for sure. I think, AI maybe in 20 years. And I know that the state of AI is much further ahead than we, the public, know. I say this, I was talking with an AI expert who had government clearance. And I was talking about DeepMind, the chess computer, right? And I said, wow, this is 3 or 4 years ago. And I was rhapsodizing about how brilliant Google's AI was. And he practically rolled his eyes at me. I mean, he didn't, but he said, Adam, there are government research labs that are at least 5 years ahead of Google. Think about that. 5 years in tech terms, that's a lifetime. And I actually asked him, I said, which government lab is the furthest ahead in AI? And the answer was not what I was expecting. Because I would have thought the NSA or something. He said the Jet Propulsion Lab has the most advanced AI. He said there's stuff that they've put on the shelf that Google hasn't discovered yet. They're let's move on to something else, guys. So AI is much further ahead. I asked him how far China was behind the US. And he said, this was 5 years ago, 4 or 5 years ago. He said 2 or 3 years behind the US, but gaining. And it's a really high stakes race. Because as you said, it's not just finance. It's everything. You get a supercomputer, it'll start to reprogram itself. And its IQ will go from 200 to 1,000 in minutes, because it'll just reprogram itself in ways human beings can't even conceive.
Well, actually, Adam, by about 20 minutes, you beat me to the punch. Let me get a little bit right to it. TSM, Taiwan Semiconductor Manufacturing Company. And of course, we have our company here in the US that's not listed on a major or on the New York Stock Exchange, even though it's a gigantic company. Is the new battleground in what is like what steel was to railroads? And it's going to, I'm assuming, power what? AI, 5G? Is it going to be semiconductors? And who's winning this race?
Well, it's a high stakes race, and in that sense, the United States is hobbled by antitrust laws, because there are other countries who are investing big time and are not hobbled by antitrust because the stakes are too high, right? And I don't know. I can't answer that question. It's a lot different from the stakes of, because it's game over, right? The first country to develop generalized AI, which means it can learn anything, it's like the Manhattan Project. It's bigger than a nuclear weapon. It's game over for everybody else. The first country to develop that. There's another, the quantum computing is another. It's
right.
Not AI, but the same kind of thing where the processing speed, something that would take years, can be done in a tenth of a second. That's also really, whoever wins that race is.
And I guess here in the US, it would be NVIDIA and there's unique things happening there. But like you said about the antitrust, and again, we could have different opinions about it, but this talk about possibly breaking up the Googles, and that would be negative from a deep mind perspective in what you're talking about. From a US perspective, you're saying, in your opinion, that would be a bad move by the government.
Well, it's interesting, because if you broke up Google, it'd still have deep mind.
True.
The key thing with AI, this is underappreciated, is not the technology, it's the data. So if you're a country, I'm not going to name the country, but you have access to all the citizens and all the data that they have, then you can run your AI and learn much faster than other countries that have privacy laws. By the way, that's not an argument for eliminating privacy laws. I'm not saying that.
Right.
But I'm saying that's the world we're in. Because the bigger your training set, the data, that's a huge edge. This is one reason why Google and Facebook and Amazon and Apple have a huge edge over everyone else. It's the data they have. It's the data that they can then, run their machine learning on, and it gives them an even bigger edge, right? But those companies are competing with foreign companies, which are given access to far more data. So we have to rethink antitrust in a modern world. We really do. And maybe those data things are declared commons, and they're owned by the country, like a commons. Maybe. For
those that will watch this or the video or the podcast, you'll see the length of time because it'll be there. But for my live audience, until Adam basically says, Angelo, enough of you, this is going to be a long form interview. I have a lot of questions, and I promise there'll be even more investment centric questions, but this all comes back to a little bit of a master plan that I have with Adam. Let's take it back in a little more of a traditional direction. Relative to the US 10-year yields, nominal yields have remained relatively in a tight range the last 6 months, yet break-even inflation rates have climbed back to pre-crisis levels, just under, say, 2%. So the real rates are a negative. And again, going back to that's one of your key indicators, what does that tell you?
Well, wait, what's one of my key indicators? You mean 10-year yields?
10-year yields.
Well, see, the break-evens that you're talking about, those are inflation expectations, right? And
Right.
so that's at 2-year highs last time I looked. I think they headed to new, right, 2-year highs, inflation expectations. And that's good. However, 10-year yields, which is my focus, like I really scrutinize 10-year yields, they're nowhere near 2-year highs.
It's like what, like 1.17 today or something like that?
Well, it was an interesting day today. It went up to 1.87, right? 10-month highs, and then closed down at 1.129, I think. I didn't check the last couple hours, but so it spiked high and then went lower. And I knew it was high in the middle of the summer. Sorry, I knew interest rates were at all-time lows, were headed higher because copper gold was headed higher. So they were leading interest rates higher. So although inflation expectations are at 2-year highs, interest rates are not at 2-year highs. So bond traders I'm not talking about the break-evens, right? The inflation expectations, but just 10-year yields, as you say, it's still negative, right? The nominal the real rates. And so what is that telling you? That people ought to temper their inflation expectations, really, is what it's saying. Because in a normal world, interest rates would not be negative, right? Where there's loan demand, economic activity, things, right? And I'll tell you something, this is really important. I want to be sure, because I know we're going to talk a lot. But the most important thing for people to understand is that the world is broken. It's been broken for 75 years. And I say broken, it's been broken since the end of World War II.
So like Bretton Woods.
Well, I'm not talking about that. I mean the world so the world has been predicated on debt, on the accumulation of debt. And debt works as long as you can grow your way out of it. And right now, we're in a collapsing, in the developed world, populations are collapsing. You got to let that land. In the developed world, by developed, I hate that word, but in the US, Canada, Australia, Japan, and every country in Europe.
Although the US, not as bad as all of them.
Hold on, let me get the thought out. More people died than were born. And this is pre-COVID, has nothing to do with COVID. For the last 15 years, more people in those countries have died than were born. And so it's not that we're growing at a slower rate, we're actually shrinking. Now, the only regions of the world that are still growing population-wise are the developing world, really. That's kind of it. And they don't make up anywhere near the consumption capacity of someone from one of those, again, I hate the distinction, but from the developed world. And so there's the global economy, the reason that we've got negative interest rates, the reason why central banks have been forced to flood the global markets with trillions of dollars is because the world is shrinking. That it's not slowing growth, it's negative growth. It's shrinking. And there's an excellent blog that I recommend everyone go to. It's called Economica. Economica, I-M-I-C-A, I think. Hard to do it from memory. But yeah, Economica. And that economist has all the stats on this. And it's, when you look at that, and the problem with those stats is demographics don't change quickly. In other words, the writing is on the wall for the next 25 years minimum.
Wow.
Because, well, just think about it. We know how many human beings are alive. We know how long it takes for a woman to get to childbearing years. We know roughly how many people are having, just some simple assumptions, it's going to keep shrinking, and followed by the developing world. So we built up debt, which assumes growth forever, and we're shrinking. That's bad. If a business is shrinking and you take on debt, that's not good, right? We take on debt in a business because we're growing the business.
Right.
And that's the fundamental problem with the world as it is now. And if you want to understand everything about the stock market, about why interest rates are low, it starts there. That the world was not viable, hasn't been for 75 years, because it was predicated on unlimited growth, because we kept piling up debt. That's not sustainable. And that's the world we're in now is the result of that.
Will the Fed cap or peg the 10-year yield at 2%?
Well, I would love to see the yield go above 2%. In a normal world, that would mean that there was economic activity and growth potential. It would mean there was loan demand. It's unlikely we're going to see that. But the way to think about the Fed can't control reality. The Fed's main tool is shaping expectations. After all, they don't actually set 10-year yields. Investors do. They buy and sell 10-year bonds. The Fed sets the rate, the short end, right? They don't really set 10-year yields. They don't. So I don't know. They can set that as a target, 2%, right? They can set it as a target, but ultimately the Fed can't fight reality, right? So the Fed can try to keep things down, but really the Fed only succeeds because it shapes our expectations. And if we think the Fed wants interest rates lower, well, why would we fight the Fed, right? That's its main tool. It shapes expectations.
I read one of your tweets where you gave, I think, 6 traits or reasons for, quote unquote, and I'm using my verbiage, a good investor. And I remember you were really big, like number 1, and this probably relates to your big 3 in terms of the indicators, is discipline. And then human psychology. And I'm reminded of John Maynard Keynes, if this relates to the latter one, successful investing is anticipating the anticipation of others.
Right. That's right. That's his famous saying. And that's what I do. I anticipate the anticipation of others, which is to say, I figure out what you're going to figure out tomorrow. I figured that out today. So I know what you'll think tomorrow, which gives me, I know, oh, Angelo's going to want to buy gold tomorrow. Great. I'll buy it today. And it's not that you can do it on a daily basis, but that's what John Maynard Keynes was saying. He's saying that really what matters about the world is not so much the world, which is pretty hard to figure out. The game is figuring out what other people think about the world, right? That's because that's what they base their decisions on, right? What they think about the world.
In trying to remember your big 3, was one of them the investment grade bonds relative to treasuries?
Right, that's the credit spread.
Right on the credit spread.
Uh-huh.
And I believe there's some like ETFs that could follow for that, probably the
LQD divided by IEF. So
that's it.
Right. So that's the credit, and that should track the stock market. And when I say should, it leads the stock market. And so the very worst that's happened is that it was coincident. It's never lagged the stock market. 90% of the time, it leads the stock market by weeks to months. And so, because bond traders sniff out risks and opportunities before the equity traders do. They're farther sighted, and they're more disciplined in what they look at, right? They're trying to gauge cash flow.
So in terms of the big three that, again, you're very gracious in sharing. I am going to mention some others that some people consider an indicator. You may find some ancillary value, but I would love your opinion. And it could be a lightning round. I'm fine with that. One would be oil.
Well, oil, see, the trouble with oil is that a lot of it is supply and demand, and it's controlled by sovereign states we don't have much control over. So oil will give you some, it's not terribly useful in terms of predicting things. And even things like copper gives you an idea, but only copper and oil are better indicators for the economies of the developing world than the US economy.
And how about the dollar?
Well, that's again a mixed bag, right? Because the dollar is always relative to other currencies. So the dollar right now is at 2.5 year lows, right? Against most currencies, and nearing 6-year lows. It's against the euro dollar anyway, against the euro. And so even though our interest rates are headed higher, right? So the dollar doesn't tell you anything about the strength of the US economy or where it's going to go. So there are times when the dollar is strong and there are times when it's weak. And believe me, I've tested it statistically a million ways. There's no predictive power in terms of the economy.
Now, we talk about copper divided by gold, but if I could bifurcate and have a conversation about gold, what do you look for from that perspective? And maybe it's getting too far ahead on asset allocation, but should families have exposure to gold?
Well, so gold is often thought of as an inflation hedge, but it's not. Any more than anything's an inflation hedge, right? If there's inflation, prices go up. So gold is just one way to store it, right? And in fact, by the way, silver, when gold starts going through the roof, silver goes up faster.
Yes.
I actually don't know that. I don't actually understand the economics of it. I accept it, but don't actually understand it. I think it's kind of a speculative thing because you can get more levered with silver. In any event, gold is not the inflation hedge people think. And so what gold is really a play on is interest rates. And if interest rates, so for example, a family member, a friend, but ultra high net worth family member asked me the other day, she said, Adam, I don't understand the break evens, inflation expectations are at 2-year highs. Why is gold struggling? I said, because it's an interest rate play, right? If you take a look at interest rates over the last, few months, they've headed higher. And gold, I tell clients, gold is shiny copper that you have to store. Gold is shiny copper that you have to store. And if store means you've got to incur interest costs, gold is actually a play on interest rates. If you look over the last 20 years, zero correlation with inflation. It totally correlated with interest rates. When interest rate inversely. So when interest rates are going down, gold is going up. And it's pretty much as simple as that.
And just to keep it kind of lightning, the Swiss franc?
Well, the Swiss franc so there are 4 safe haven currencies in the world. I'm going to tell you. The dollar, gold, which is actually a currency, gold, Japanese yen, and the Swiss franc. So the key indicator to watch for the Eurozone, especially now with Brexit and all that, is the Euro franc, which is EURCHF, right? The Euro franc. It's the exchange rate between the Eurozone and Switzerland. So the Swiss franc is really key because when the Swiss franc rises sharply against the euro, it means Europeans are scared and putting their money in Swiss bank accounts. So that's really key. So again, the safe haven currencies in the world are US dollar, gold, Swiss franc, and Japanese yen. depending on the region of the world, right? In Asia, if people are worried that to put their money in yen and so on. So those are the safe haven currencies.
Ironically, it's on my notes, I promise. After the Swiss franc was the yen. What do you think of the Dixie? Kind of the dollar and the euro against the dollar. Is that any what of an indicator to you?
What you mean? You mean the euro dollar?
Yeah, yes.
Okay, so the euro dollar, it's not really an indicator. In other words, the euro dollar going higher or lower has not a whole lot of predictive value for the economy of either region, right? The United States or Europe. I will tell you right now that the euro bottomed, it bottomed on March 20th of last year at 106 and change. It's now 122, which means that European goods are 15% more expensive for Americans. Europe does not like a high euro dollar. Europe doesn't like it one bit. You know, think about it. There's no tourism to speak of in the world right now. And the euro dollar's like their nightmare because a high euro dollar, because it means that their goods are expensive for the rest of the world. They don't want the euro high, they want it low so they can sell more products.
And my last one in terms of indicators that I kind of look at would be lumber. Do you think that's anywhat of an indicator to economies?
Yeah, I've checked it. You know, again, all these things I want you to know that I've checked and rechecked and, you know, multiple permutations. So lumber relative to oil, lumber relative to copper, lumber relative to everything. Like I check every kind of permutation. And I haven't really found too much, you know, nor with, you know, lumber, if you think about it, is with construction, right? Housing and such. I guess really not office towers don't really use lumber these days. And so really residential construction. And it maybe in the 1960s, that was an important indicator. In the modern world, it doesn't seem to be, you know, dwarfed by everything else, like the other indicators.
And Adam, and I'm getting a little off topic, but that's typical for me. Where am I wrong in this assumption? And I'm not new to it. I heard it from multiple others, including my very wealthy family. So it's very specific to very wealthy families. Could I make the argument that inflation for them, the CPI is a joke? Suppose they live in New York, they buy homes in Malibu and the Hamptons, they own art, they buy sports teams. Could I make the point that their true inflation is maybe 10 or 15% a year?
Well, but they love that inflation because they're invested in those things.
That is the answer. You're correct.
Right? And that's, you know, one thing that people, they say, Adam, why has the government been printing all this money? Why hasn't there been runaway inflation? There has in stocks. That's where there's been runaway inflation, right? The cash, what people think is if we double the amount of money in the economy, which is what's happened and more than doubled, well, then prices should double. No, they'll only double or they'll only rise in things that people want. And for there to be inflation of the kind that people think of, like in the 70s, right? Where everything is the cost of everything going higher, including wages, right? It means that there's got to be demand for those things, but there isn't demand. So where does that cash go? It goes into stocks and bonds. That's where it goes, or art, right? Or Malibu homes, or whatever it is.
And those are going up and up for now.
But that's the kind of inflation they like. Yeah, okay, I want that inflation. I want my investments to go higher. What's wrong with that?
Should we have some concern? Because it would mean, I mean, people, they need, you know, the basics. They need shelter and they need to eat. If food inflation were to explode, do you think the government would step in? And I'm giving you a crazy example. They would cap a gallon of milk at $5 a gallon.
I don't know. But the thing is, the government's already stepped in. Now, it's hard for your family members to appreciate the despair. I use that word advisedly, the despair of the average American.
That's true.
So despair comes from the Latin and French. It means to be beyond prayer. Like I give up. Despair leads to desperation, right? And acts of desperation. So here's a factoid for you, and I'm pretty sure we discussed this in our last April. So in 2019, so this is before COVID, assume everything I'm saying is pre-COVID, unless I say it's now different with COVID. So pre-COVID, 48% of American adults had $0 in the bank. You really have to think about that. 48% of American adults had $0 in their bank account. No cash. I don't mean like what we would consider to be no cash. They had no cash. Now, let's humanize that, because that's a number. What is that? But think about that. That means 48% of Americans lived in a state of peril. They didn't know where their whether they'd be able to feed their family at the end of the week. And everything is okay so long as you've got a job. But God forbid there should be some unexpected expense, and then I'm screwed. So the stat for 2019 was 48% of American adults had $0 in the bank, and another 21% had less than $1,000. So if you add those two numbers, this is pre-COVID, 69% of American adults had less than $1,000 to their name in available cash. That's horrifying. And so when you say, is the government stepping in? The government's already stepped in. I think the national debt has gone, from 9 trillion to 19 trillion. They've just been printing up money. And so the government's already stepping in, which is why a few years ago, there was talk about universal basic income. Right? They're just kind of floating that idea, and it came out of Silicon Valley because those guys realized, technology is going to make it awful hard for people. They're going to be displaced. And that's the reality of our world. And so you think about that. Most Americans, that was pre-COVID. I'm guessing the number has got to be 80%, right? If it was 69 before COVID, it's easily 80%, maybe higher than that. No money on hand, just a lot of credit card debt. So of course the government has to step in. We don't need hypotheticals like, what if there's runaway food inflation? Already they don't have money. Already they don't have money. This is a crisis that's just unparalleled.
Okay, let's jump. I was going to bring up that subject a little later. I'll bring it up now. So I've been thinking about this for a while, but I read this week, she was on my show about a month ago. She's great. Her name is Lynn Alden. And she came up with, if we strip away the high-tech veneer, have we been in a 12-year mild recession in the US? I don't know if I quite agree with that, but for a portion of our population, the answer is yes.
No, I'm going to disagree with respect, Angelo, with respect. I understand what you're saying, but I'm disagreeing with the notion of a recession. So a recession assumes a normal economy, that you've got an upward growing economy and that there's a little dip. And then we go back to our normal growth curve. Well, no, there's no growing economy. So you can't have a recession in an economy that's shrinking. You can't. Now, economists can define it as something, 2 quarters of lower growth, but that's a joke. That's a joke. That's economists looking at numbers. The reality is that we're in a shrinking economy. Again, you just look at the amount of cash that people have available. It's horrifying.
Okay,
and that's real human pain. So recession, you can't talk about a recession because there's no normal economy.
Well, then how would you define that people over the last 10 years in finance, healthcare, government have done relatively well, but the flyover states in this country where there's manufacturing, where there's the blue collar jobs that we were just talking about, they've been devastated.
Devastated, devastated, devastated. And so I don't want to get political, but I do want to say that it pains me when I hear people talk about this party or that, and there's no recognition to the real pain that people are in that drives them to do desperate things. These are desperate times for most people. And talk about unity and coming together. Oh, wait a second. You mean unity like you're going to share my economic pain? Is that the kind of unity you're talking about? Because kumbaya unity is out the window. There's no, we're going to get all touchy-feely and come together. No, because I have no money. So you're exactly right. The people who have done well in the world have done extraordinarily well, but there's such a small percent of the average human being's experience of the world, which is at this point, again, most people are borderline despairing. They live on hope. They hope, oh, okay, well, we'll have a vaccine and I hope things will get back to normal. But no, they're not going to get back to normal. Normal wasn't sustainable because it was built on debt. And the debt was predicated on continual population growth, which ain't happening. It's not going to happen for at least the next 30 years.
Does China have a similar problem with their population?
Huge problem. Oh, they've got it worse than we do. They're really scared because they had that one-child policy for many decades, right? They had one child, each family was permitted one child. So much for central planning. Not a good idea, because then what you wound up having, two problems. One is not enough young people to support this, the really expanding elderly population, but also that one kid, more often than not, tended to be a boy. And so in China, there's the number of single men is, I think it's like 11 to 9. Wow. 11 single men for every, it's either 9 or 10, but even 11 to 10 is a big problem.
Right. Yeah.
10% of their guys aren't going to have a dance partner, right? That's a big problem. China, after decades of just one, they finally realized, that was not a smart move. Unfortunately, the demographics are written for the next 30 years, right?
Right.
So last year, it's funny you should ask about China. Again, this is 2019. In 2019, after a year of browbeating the people, please have children, they recorded the lowest birth rate that they've had in decades. That's with government pleading, please have kids. Nope, young people aren't having kids. And that's with, really, tax incentives and it's your patriotic duty to have kids. No, they've got the problem there too. It's worse because it's decades in the making.
Wow. Yeah, it's quite a, now when I add to this, I don't want to scare people too much, although maybe I do. So we have the trends that you're noting, coupled with what we spoke about earlier with advancements in technology, in quantum computing, in deep tech, quote unquote AI. Mm-hmm. It seems inevitable. So when I'm asked what are the greatest threats to the super rich, I'm not saying I like that term, but let's go with it. It is not that they're not getting 100 more basis points on their investing, maybe a little concern over purchasing power because I'm a little bit more inflationary concerned. But the big issue to me is chaos. It's uprising. Yes. And I think you ask wealthy families pre-COVID and pre the civil unrest that we had, which was after we spoke during COVID in April, oh no, this is the US. That could never happen. And now when I survey my families, especially if they're second generation American families of wealth, and they come from countries where they know things could go wrong, that number is up to, I don't think that's going to happen, but now it's not impossible. It's 5 or 10%.
Oh, no, it's much worse than that. So
Thank you,
oh,
Adam.
by the way, it sounds like I'm a doomsdayer. No, I'm always, in fact, looking for the opportunities. This is a time of incredible opportunity for anyone who sees clearly. It's not a question of being I'm not trying to make people scared. I'm just trying to get people to see clearly. And then once you see clearly, you can make decisions. So the social unrest is we've just seen the early, it's just the start of it. Just the start of it. Again, if you're just on the pure economics of things, people are despairing. And the middle class has been gutted. Essentially, the middle class has been eliminated. And so the way to think about it, the American dream, the acceptance of wealth inequality was always, people were okay with wealth inequality as long as there was a path upward. Like, okay, I didn't go to college, but my kids, they're going to go to college and they'll be able to earn more money than I did, right? That's the average American's thinking, right? And they were okay with wealth inequality because they thought, okay, by hard work and contributing value, and and an education is a part of that, preparing one, then they will earn more money. But that's gone. That American dream is gone. And so, you look at kids coming out of school with massive student loan debt, which is really family debt that they can't escape from. And really, people are without options. You really have to see that clearly. People are without options. And again, I'm not condoning civil unrest, but it's of the kind that we've seen recently. But it's a sign of how despairing people are. People don't just decide to do something. We would go, oh, that's crazy. That's ridiculous. Well, people don't do that kind of thing unless they don't see their options, right? And that's really, coming together in unity is that like, oh, come on, we got to solve some real problems as a country and as a planet. And the coming together has got to be on the reality of how can we design a system that if there is inequality, there's a fair opportunity for anyone to rise within it. And that illusion is gone. So wealth inequality, I'll tell you what families are worried about: taxes, right? You know that. They're terrified of taxes. And already there's been a flight from California, like Elon Musk and others headed to
Nevada, Wyoming, Texas, etc.
Right, and Florida, right? There's been a huge exodus because it's clear federal taxes are going up next year, or I don't mean next year, this year, right? They're going up everywhere. And so to try to address, it's just the first little step of it. So that's coming. And the social unrest, I was speaking with someone and she said, well, I hope things get better. And I said, I don't live my life on the basis of hope. I don't choose a brain surgeon hoping he's going to do a good job. I'm going to do my research and I'm going to find the best brain surgeon there is. I'm going to find the best tailor there is. I'm going to find the best everything. I'm going to do my homework. I don't live on hope. And so I don't hope that things will get better. I see the way they are. And until I see evidence of change otherwise, things are going to be tomorrow exactly what they were like today. What we're seeing is escalating social unrest. That's the reality. We're not seeing, it's escalating. And in a really bad way, right? Whoever would have thought? I mean, it's like a parody of these adventure movies where the White House has been taken by terrorists. Well, what the hell? This is like a parody of that. But it's not funny. It's not a parody. And forget that they were incited to do that. You can't incite people who are optimistic and have choices in their life. You can't incite them to do stupid things. most people are good people, and to demonize desperation is not to come from a place of compassion, and certainly not going to cause any unity to happen. You have to. I think we have to acknowledge the real grievances that people have in the United States. I want to reread de Tocqueville's Democracy in America. Okay, I haven't read that since college. And I think that would tell us a lot about the state of America. I have to reread it through the lens of the world today. Right?
What would you say, Adam? And it's getting off topic. I've had this discussion a lot in 2020 with global attorneys and others, and that is significant U.S. families exploring their options, even if it's not a tax play, whether it's Canada, New Zealand, and Australia, Sweden, terrible on taxes, but they have they're not involved in the global geopolitical scene per se. It's deemed to be a more unity, but is that running away from being a patriot, or are they just simply exploring their options?
So there are a couple things there. And, it's a really good question. And I'll tell you something, because I'm a libertarian. I went to Wharton and Oxford. I'm as fiercely libertarian and capitalistic and as they come. And yet, I understand the need to feel protected, right? And if you're the patriarch or the matriarch of a family, and you you got to protect your family, and whatever you do around that, you hope you don't have to do that. You hope you don't have to move to one of those safe haven places. And I think you want to prepare along those lines, but still be committed to trying to really help here. And for me, it's, you think about the country that gave you, those opportunities and where you made your fortune, and okay, well, see you guys later. I'm off to New Zealand, and, or Canada or wherever it is. I understand that need to be protected and to have a way out. But I also, I think we all ought to, and I think those family members themselves would be the first to say that. That's our last resort. We hope we don't have to leave. This is our country, I hope. I think that would be the attitude of families who do that.
It is. There's a lot of chatter about it, but relatively few move forward. And if you're a significant family, especially billions, the cost of leaving with the exit is truly significant. So it's interesting discussion for people, but at the end of the day, they need to make it work from this perspective. That brings up another, and it's not in my notes, so I'm not even looking at my notes. The super wealthy that I guess I represented, Family Office Association, and I'm a libertarian like you, they could own what? Real estate in stock that get taxed favorably if you don't liquidate it, but you could borrow against it with no tax implication. Real estate has tremendous passing on through 1031 exchanges. And then to pay no estate tax, they could put all their remaining money, let's forget about other complex estate planning strategies, into a private foundation, and they could control, to some degree, political policy, charitable, and their family being active without really ever paying taxes. And I'm anti-tax. I'm a libertarian. I'm very fluid on tax issues, and that's a big thing for my members. But sometimes I do admit, when I scratch my head and think about that and look 30 to 50 years out, are we getting more money now for a worse world 20, 30, 40 years from now?
Well, I don't know. It's a layered question.
To say the least.
Dude, I wish I could remember which Supreme Court decision it was around taxes. And some famous judge said, I have to look this up after our conversation. It's that American citizens are not under an obligation to, in other words, they could do whatever they want to minimize their taxes, right? And so I understand that wanting to minimize one's taxes and to play the game. in a sense, the same people who've built up wealth have generated probably tens of thousands of jobs for people.
Absolutely.
So yeah, they've piled up and I'm there. I can understand they're avoiding taxes. Great, right? If that's the tax code. But by the way, they've also contributed greatly to the country, right? Through their economic activities.
Absolutely. And they pay taxes. Okay, maybe not after the income tax, then they may buy stocks and real estate. I get it. I completely agree. That being said, though, the issues that I mentioned are real, and the bifurcation of the haves and have-nots, that's getting worse, social unrest. And in theory, the have-nots have equal voting power. A vote's a vote. In theory, their candidates are going to win. And then that creates the issue of policy, of taxation, and of things really spiraling downwards. But okay, Adam, we're talking about all the negatives about this. What do you think could be some of the solutions?
Well, the first is to look realistically at what's at the world as it is, and not in hopes. And by the way, when the Federal Reserve decides to, okay, we're going to engage in more quantitative easing, that's hope. A businessman, an entrepreneur, doesn't do something hoping it'll improve the business. They've researched it, they've done whatever they can, and this is, to the best of my knowledge, this is definitely going to bring in more people into my business. They're going to buy more Apple Watches or whatever it is. And so I think it starts with looking at the world as it is, not on the basis of hope, and starting from there. I think we have to acknowledge the grievances that people have, and there are many grievances. We haven't gotten to the social ones. I've just dealt with the easy ones, the economic ones. There's social grievances, right, that people have. I think we have to acknowledge that as a country. And so that's a starting point, just seeing clearly. And there are many opportunities, just when things are, it was during the tech implosion of the last tech bubble, right, in 2000, that Google was born. There are a lot of companies that do very well in difficult times, right? And so there are incredible opportunities for those who see clearly. Really, there aren't many times in history that I can think of where things are upended in such a discontinuous way as they have been this last year. So incredible opportunities for family members to invest if they're on the right side of things.
This is completely out of left field. It may cause some people to either do this or to chuckle. We have an amazing entrepreneur that was not born in this country, is still relatively young. Hopefully he has 50, 100 years left. We have in the gentleman that created Tesla, that is changing energy, technology, climate change, and Elon Musk. Is someone like that, like arguably, I don't know if I want to call him an inventor, but could great current Americans change the path that we may be headed?
So this is what's required. By the way, I think Musk is a genius, right?
Absolutely.
A visionary genius. And yet, this isn't a tech problem. The kinds of solutions that are required for the United States right now require the kind of genius that I'm not sure the founding fathers had. And I don't know that where you're ever going to find social, political, and economic genius like that ever again. Right, I don't know, a dozen dudes who all knew each other and said, let's create a country. We're going to build it from scratch with no model. Well, I mean, they had, some ancient Greece, they had some models, but not many. And they created a really brilliant invention. So they were inventors, they were technologists, they were human technologists. How can we get people to, create an institution, not an institution, a country where people are going to be engaged? It's going to, create economic activity and opportunity, and will prevent excesses, with checks and balances. That was a genius invention. Now in the modern world, it's not working too well, right? And so we need that kind of genius. We need the social, cultural, political, economic equivalent of Elon Musk, because they're not tech solutions. That's for sure.
Yeah, good luck, but let's remain optimistic. And we may come back to this issue when I have you back later in the year. We are getting some questions in, and I want to be respectful of Adam's time. We'll try to keep it 20 more minutes. And
Well,
relative
I'm
to
having a blast. You talk as long
okay,
as
let's keep it going. Well, someone commented more to me, Angelo, but the wealth tax, yes, but in theory, giving it all to a foundation makes that it wipes that away, as you know. And there are various strategies up to a couple of $100 million that families, if not even billions, that families could be proactive in. So trust me, taxes are probably my favorite issue to do a deep dive in. I do not want to make that the focus of my discussion with Adam, but feel free to reach out to me, and I'm happy to listen to all sides. And again, coming from a libertarian who thinks taxes are too high, but it's more complicated than simply just saying that.
Yes.
I'm looking at some of my questions, and I think we already covered some of them, but I'm going to ask it and try to do it from a little different perspective. It's ironic that this one pulls in front of my face over some of the challenges that we're talking about. What do you think the world will look like and change into in 10, 50, 100 years? I mean, how the hell do we know? But I'm going to ask it anyway.
Well, I'll tell you something. If we don't get the next 10 years right, it doesn't matter beyond that. And when I say the next 10 years right, we really got to get the next few right. Because the backdrop is this. Algorithms and robots are going to do whatever a human being can do better, faster, cheaper, more efficiently, and more accurately, right? In every respect, better. And that's just a matter of time before they displace. I can't think of an industry or a sector that's not going to be just totally overturned. That's coming in the next 20 to 30 years. Now, the problem with algorithms is that they're trained, and they can be trained now, right? And so we want, in a sense, good algorithms, not bad algorithms. And the problem with the world, one of the problems in the world, is someone asked me for 3 words to describe AI. And I said, optimizing, relentless, and unforgiving. That's AI. Optimizing, relentless, and unforgiving. And that's true of capitalism. Same thing, same logic. Optimizing, relentless, and unforgiving. And what we need to do right now as a planet is there needs to be some tempering of the excesses of capitalistic logic taken to its extremes, because it's wiping out people, right? And they can't be retrained because technology is basically going to make everyone. In England, when you lose a job, it's said you're redundant, which is a horrifying concept, a human being being redundant. But human beings are going to be redundant next 20 to 30 years. That's coming. That's the backdrop. And whoever wins that race, boy, they better have a good heart. Because the machines aren't going to. The machines don't really care. And so really the idea of generalized AI getting out of the genie bottle is, if you aren't scared, you haven't really thought that one through. And, the thing is, it's not like AI is it's not like the Terminator. Like AI is going to want to hurt us. It's just AI isn't going to care. It's going to be smarter than human beings. And at that point, a super intelligence is no more going to care about a human being than we care about ants. So that's coming. And so the next 10 years, boy, we got to get these problems right, because the social unrest, that wealth inequality, that the grievances that people have, that needs to be addressed now in a way that people really, at the very least, feel heard. Even if you don't have a solution, just listen. And we have a hard time now because everyone's shouting at each other. So we got to get that right, because the social unrest is going to lead to more social controls. And you and I are libertarians. And these social controls are not going to, once they get implemented, they're not going to be taken away.
Yeah, just like when they rolled out the income tax in 1913, it was going to be temporary, of course. What's the one thing that should be taught in school that isn't? And now with the overlay of what you're just talking about, what could be the next 10 years will be so telling. I mean, I have a child who's a senior in high school. He's going into college in September. And yeah, I want to be in business and finance and the stock market. And I'm like, I don't know anymore.
Yeah. So, it's an interesting question, because it's really the question. I'm going to strip it down into two parts, because you said, what should children be taught in school? And the thing is, the kind of skills they need to be taught, I don't know that they can be taught in school. Right? School has a hard time teaching kids how to read and write and basic arithmetic, much less the more sophisticated skills, right? And so I think one thing that ought to be taught, and again, I don't know that schools is the right institution for this, but here's a skill that people ought to be taught. And I think this is, regardless of the world, this skill, I think, is one where a human being always, well, I was going to say always have an advantage, but maybe not in 50 years. But for now, the ability to connect with and get other people excited about your vision. And by the way, Elon Musk, you mentioned Elon Musk, he's great at that.
The
he
best.
comes up with something and people go, yeah, let's do that. Let's go to Mars. Yeah, Elon, let's hack death. Let's do that. And so the ability, if you think about it, we don't do anything in the world without other people. So the ability to enroll others in your vision, what you want to do, what you want to see, is the key to success at anything, right? To fundraising, to starting a business, to a relationship where somebody goes, yeah, I want to spend the rest of my life with you. And it's so the ability to excite others with a future. And I think
that's not taught in school. That's
No,
like
it's not.
emotional intelligence. That is salesmanship. That is active listening. Where are they going to learn this?
Right, but that was my point. Like the kind of things that ought to be taught that people are going to need, real skills in the future.
Well, maybe that's our responsibility as parents.
It can't be taught in schools. And then, yeah, I think parents are going to have to take a more active role. And really, it's the ability to communicate with others and to connect with others. Those are sales. To call it sales skills is to, I think, undervalue a little bit, because it is sales, right? Even when you're presenting an idea, that's selling an idea. Yes, it is. So when you said salesmanship, I knew what you meant, but I don't think people, it's not like we're going to sell more cars, but just to sell people on possibilities. Yes, let's get together and do that, right? After all, the American Revolution was about a bunch of guys who galvanized, half the colonists. People forget, half the colonists did not want to leave England, thought that was a big mistake, right? And so you had a bunch of guys who had to galvanize, at least half the colonists to go, no, we actually have a cooler thing we want to start. We're going to call it the United States. As soon as we get it done, we just have to we defeat King George and hope we win the war so we're not killed for treason. And so I think that's, by the way, that's one of the things missing in the world and in leadership, is getting people excited about a vision. Excited. That's a key word. Excited. Yes, that's going to work. Let's get behind that. And that's really needed in the world. And And it'll take a real visionary leadership of the kind that we had with Churchill. And I'm not saying I agreed with his policies, all of them, Franklin Roosevelt, sort of an anti-libertarian, but nonetheless, he was a leader. He made people feel that he was, a leader in difficult times. And that's really what's needed in the world. It's needed in America. I don't know where that's going to arise.
Neither do I, and I don't know if anyone knows, but it'll be interesting following it. To change things around a little bit, because again, I like to be sometimes nonlinear. I'm a little quirky. That's how I think. I'm going to go back a little bit to more boring classic finance, but I think again, this all weaves together and interplays. I probably don't want to do 10 or 15 minutes about modern monetary policy, Bretton Woods, which I briefly brought up earlier, and everyone now, I mean, all these macro people that I have coming on, they're pounding MMT. It's all bad. It's all bad. Is there anything you take from it as something that, well, maybe it's not all bad. There are some interesting things that we could learn from it and move forward with better policy?
I don't know. I really honestly don't know. I don't even think about it. I honestly don't even think about it, because even the policy is predicated on a worldview. And if you're not seeing the world for what it is, which is to say shrinking and like fewer people and fewer for the next 30 years at least. And again, as a resource, I recommended the blog Economica. I forget the economist's name right now, escapes me, but brilliant thinker and presents all the data on this, and you just look at the numbers. So any policy, I want to try to focus, Angelo, on questions that our family members can really use and not like theoretical. Like I don't think too much about monetary policy because it's predicated on a world that doesn't exist. Well,
yeah, no, that's a good way to think about it. Well, then I guess my central bank question may not be too much better relative to the US dollar, which we briefly discussed earlier. Do you think about, and does it really matter to you that really SDRs may be kind of the secret of the central banks? And I was going to weave that into my IMF question coming up next.
I'm not sure I understand the question.
I'll slightly rephrase it and go actually to my IMF question. Is the IMF secretly the global Fed?
I don't know. And, the question is, I don't know. I don't think about that question. It doesn't help me anticipate markets. I can't imagine as a family member, like whether it's true or not, we can speculate on it. But at the end of the day, are we going to change anything? Is it like, I don't know. And there are more pressing issues that I do devote my attention to, not whether, the IMF is a global Fed. I am concerned with the controls that are being put into place as someone who respects individual freedom. I'm deeply concerned about that, and that's a global problem. But apart from that, I don't think about it, and I really want to. I can spend all night talking about that stuff, but I really want to give family members and your.
I got one person that sent me a text saying that one of the best thing they learned in their Ivy League education, they actually learned from a professor on the first day. I'm not sure if they're saying that just to have dramatic impact. And I'm going to basically tell you what it is. It's 3 words. The professor said, think for yourself. What do you think about that?
Well, it's not helpful advice, right? Because he hasn't shown the student how to think for yourself. Like, that's all well and good. It's like, have a positive mental attitude. Well, okay, but I don't. He hasn't empowered the student to think for himself, right? Or even, how would you know whether you're thinking for yourself? Like, yes, it's true, but simply saying that doesn't, listen, I say this because, I co-founded the Princeton Review, and my job, I had to ensure that when a kid came in the course, by the time he took the SAT, his score was up significantly. And so I could say, well, just think for yourself. No, I had to train that kid to think in a certain way. And so to think for yourself, yeah, but it's not helpful advice because he hasn't shown. It's like telling a comedian, just tell funny jokes. Oh, okay, thanks for that. Or telling anybody, just be yourself. It's not helpful advice because they don't know how to follow it. And so it's true, but it begs the question, how do you think for yourself? Most how-to books aren't how-to books. They're what-to books. They tell you what to do, but they don't actually show you how to do it.
Yeah, those are all good points. I do have a series of questions from the audience and family offices, some that have texted me that are coming in. And I think these are always difficult. Some of them, of course, it's investing. So your risk tolerance, your timeline, there's so many different factors that make it nuanced. That being said, I still have to ask them. We're getting like your opinions about investing. For instance, we had a very well-known guest last week, very well-known, say 30% in cash, 20% in US Treasuries. I myself, and he's way more educated and experienced than me, thought that was incredibly high. Do you think that's too much cash and money in treasuries?
Well, so this is someone who is, I guess, expecting things to
deflationary,
south,
right? I would say, yeah.
So I have to be careful about providing investment advice like to the public like this, but I can tell you how to think about it. So, it's in treasuries or cash. If you were thinking things were going to go south, why didn't he say they're going to go south? So I actually recommend that you buy the following sectors and short the following sectors, right? If they're going to go south, well, why not make some money, right? So just to say, I don't know what's going on, but I think it might be bad. So better to hunker down in treasuries and cash. Okay, you can do a lot better than that, really, if you thought things were going to go south. And
that's a very good point.
For example, if they go south, I know that US stocks will do better than global equities. And so I know that hold on one sec. I just want to make sure that I got enough battery in my computer, because if I don't, I just plug it in. Where's the battery indicator? Okay, because I don't want to get disconnected from you.
Of course, Adam.
Give me 2 seconds. I'm going to plug in my computer just to make sure. Hold on.
Sure. And while Adam's doing that, everyone, my God, I probably still have about 8 pages of notes, which would mean about 2 more hours of a podcast. I am a very curious and inquisitive person who really doesn't know that much, but is not afraid to ask questions. But I do want to engage the audience more. Adam obviously has been incredibly generous with his time. We're not that far from 2 hours already. So this will definitely break the record of my longest YouTube video and my longest podcast, my longest live interview ever. I just think the world of Adam. I think he's incredible, a great thinker. I may not agree with everything that he talks about or does, but
you don't agree with me?
Adam, I'm you give me the floor for a minute and I say stupid shit. What can I say?
Okay, so wait. Okay, I'm plugged in my computer there just because so there we go. Okay, yay. Okay, cool. So I'm fine. Okay, so golly, what was the question before my?
So 30% cash, 20%.
Oh yeah. So really, if you thought things were that bad, why don't you just short? Why don't you hedge your investments? Right, like there are more sophisticated strategies than that. Right, you could short global equities. Right, if things go south, I know that weak companies. Here's the way to think about the world. In a low to no growth world, winners take all. In a low to no growth world, and this is actually negative growth, in a low to no to negative growth world, winners take all. and they will outperform, especially when things go south, right? So I know that the strongest companies will outperform the weakest. So if you thought they were going south, why don't you just short the weakest companies? Like that's, I'm talking about, I'm not giving investment advice. I'm not saying they are going south, but if you thought that, that would be a better way to play it than just park your money in cash.
And we had another very well-known global figure on around Christmas time that spoke about 25% plus in commodities. And I asked him to break that down a little bit. Gold, oil. They did bring up two interesting commodities that I've dived a little bit into in the last couple of weeks, uranium and rare earths. I don't know if you have a specific opinion. You probably do. I hope.
So, you know, Warren once said, diversification is for those who don't know what they're doing. And, you know, that's like someone going, well, I don't know what's going to happen. So have a little bit of gold and a little bit of uranium and a little bit of rare metal earths. And, you know, I'll tell you something, if things are so bad that you've got a significant portion of your wealth tied up in rare metal earths, if things are that bad, like they're going to spike through the, you know, and they might, right? Because I know a lot of rare earth metals come from China, right? Come from people that.
Yes, they do.
Right. So there's some issues there, right? And you know, I'm not saying those aren't great plays, but it sounds like, oh, these are things that could go up a lot, you know, so commodities, again, what we've seen over the years is declining prices, not rising prices. So to stick a significant portion of your money on a bet that think prices are going to rise, that's a fairly significant bet. And I don't know if, again, gold, if interest rates are rising, gold will rise less than oil. If interest rates are rising, remember, gold is an interest rate play. So that I mentioned earlier, a while back in our conversation, this family member who said, Adam, I don't understand. There's inflation expectations. Why is gold underperforming? I said, because gold underperforms copper and oil when there's inflation expectations, because interest rates are going higher. And if interest rates are going higher, gold is going to underperform those commodities. So I'm not going to opine. I'm sure that there was more thinking than I'm giving credit to those people. So it's not. So I understand the uranium. I understand that play. I understand the rare earth. I understand that play also. And gold and oil. Well, in a sense, what that's a play on is inflation and deflation. In a deflationary world, gold goes through the roof. In a deflationary world, gold goes through the roof. Why? Because interest rates are going through the floor.
Right. With
negative interest rates, you're paid to own gold. Think about that. Negative interest rates, you're paid to own gold. So again, rising in deflation, interest rates fall and gold rises. In deflation, people always think gold is an inflationary hedge. No, it's a deflationary hedge. So I understand gold and oil, you kind of got yourself covered for both. But again, it goes back to Warren's thing. You're diversifying because you don't know what's happening.
You know, very good points. I got a question in that I'm going to give a little twist to. And Elon Musk comes up again. It's a Tesla question. I have someone, I believe he's going to come on next week with his son, where he's about my age. And his son is, I believe, in his mid-20s. The son has made a killing investing in Tesla, being very concentrated, of course, Bitcoin and Tesla. And the father's like scratching his head. I just don't get the metrics of Tesla. Why does it keep on doing so well?
Okay, so that's the wrong question. So again, he's saying it doesn't make any sense, right? It doesn't make any sense that Tesla's going through the roof. And now it's a very, you've got to be nimble and you can't do it in size, right? But you basically what the father's saying, it doesn't make any sense that Tesla's rising like that when the fact is it's rising like that. Now his son, who's probably not investing, massive sums of money, maybe his own personal wealth, but not really in the scheme of things. But if you had a significant size in Tesla, significant, I don't know, multiple tens of millions in Tesla, you might have trouble exiting your position if Tesla were to decline sharply. Now, I'm not saying this guy is a genius, but I'm forgetting his first name. Burry, the one who made
Michael Burry, Dr. Michael Burry.
So, right from The Big Short.
He is, yes, and he's shorting Tesla right now, if I remember correctly.
Right. Now, by the way, people forget in The Big Short, he almost went bankrupt, right? He just barely, and there were a lot of people who knew about the housing crisis. They just bet short too early. So Burry was lucky, right? I had friends, I remember in the 90s, they were shorting Yahoo with glee. They were going, oh my God, Adam, I'm shorting the heck out of Yahoo. Can you believe it? It's like doubling in price every week. And I said, and you're going to get in front of that? You're going to, remember, it was John Maynard Keynes who said the market can stay irrational a lot longer than you can stay solvent, So his son is looking like a genius. Like, yeah, Dad, I told you Tesla was going higher. Yeah, wait till it collapses, because it is pretty far divorced from anything. Now, I'm not saying short it. I don't think you should short anything going up, especially in the midst of a speculative mania, because Tesla could drop in half in a week and it wouldn't surprise me. I could also see it doubling. Right?
Adam, that brings me to my next question. You knew it was coming. We talked about it a little bit in April, and it's a great segue from Tesla and what you just said.
Yeah.
Of course, it's Bitcoin.
Yeah.
So since we left off, now we have some major well-known investors, Paul Tudor Jones, Cathie Wood, Druckenmiller. We have institutions, Mass Mutual. We have some. So what is your current opinion?
Okay. First, it's just gambling. Bitcoin. I'm not talking about blockchain technology, but you're not investing in Bitcoin. You're gambling. It's a straight gamble. It's a straight out and out gamble. And you're up against people who manipulate the price, right? It's harder to do today than it was a couple of years ago, but the price is, it's not unlike, the trading bucket shops at the turn of the 20th century, before the SEC started to prevent that kind of stuff. Now, I can't say whom, but one of the smartest people in the world around finance and technology, so you just have to take it on faith. And I can't say who this person is. Way smarter than everyone you just mentioned combined, has suggested there's a flaw in Bitcoin. So that's all I can say. So that doesn't mean that Bitcoin isn't going to double. But when this guy suggests that there's a flaw in Bitcoin, then he's like one of the few people in the world I go, wow. So yeah, just take it on faith. He's way smarter than all the people you mentioned, way smarter, and with technology. So with finance and technology, and he's hinted that there's a flaw in Bitcoin.
Maybe a little bit related to that comment. And when I do ask certain guests this, they seem to get a little mad at me. Hopefully you won't, Adam. I'm a little sensitive.
I haven't been mad ever at you.
Did the NSA, I think back to the mid-90s and SHA 256, do you think the NSA created Bitcoin?
See, I don't even begin to speculate on things like that, because it doesn't, at the end of the day, how does that, I have no idea. So I don't go down those rabbit holes, because at the end of the day, you're just speculating one way or the other, and it's not going to change my opinion of Bitcoin.
Okay, let me ask you that question, Adam. Like we brought up earlier, what would cause you to change your opinion?
One of the smartest people in the world I know, and I know a lot of smart people, has hinted, without giving away all of this, like, that he's found a flaw in Bitcoin. And if it were anyone else in the world, I would dismiss it. But when this guy says, maybe there's a flaw, maybe it could be mined for half the energy cost. Would that be a good short? I listen to that guy. And that's the extent of what he said. And he's just you just reveal his name. He's not, you would not know.
So is that relative to who controls the hash, the mining power? Is that the issue of, could it be nationalized in China if that's where most of the power is coming from now?
No,
in that direction?
No, he's just saying there's a flaw in Bitcoin, that fundamentally, to him, it looks like a juicy short. Now, by the way, if you're going to short it,
and you could with the CME.
Well, yeah, you could, and you might deal with the Bitcoin going up 10x.
Absolutely.
Before it collapses, right? That's the hard thing, expressing these views. I'm sure that Michael Burry's going to be proven right on Tesla. I think Elon Musk himself is going, what the hell is going on with the price of, this doesn't make any sense, but he can't control it. So I have no doubt but that Tesla will come back, because it's just wackadoo. They've discounted all possible things that Elon Musk could come up with. Now, by the way, in the speculative bubble in the late 1990s into 2000, those companies that were going through the roof later proved to be justified. I don't mean like Petco, but all those companies like, Amazon, like, it turned out the valuations were right. It's just they discounted 20 years worth of growth. Right? And so Tesla, they've already discounted the next, 20 years worth of growth in that company. But again, we're in a world, think of it as Alice in Wonderland or Adam and Angelo, anyone, it's Wonderland territory. And with so much capital, the logic of global capital flows, it wouldn't surprise me if Tesla were 10x from here 2 years from now. Wouldn't surprise me, And by the way, it wouldn't surprise me if that were true and the market had collapsed.
Wow.
But even in bear markets, some stocks do really well. It's not a bear market for all stocks. And so yeah, that we're seeing a world that bifurcates winners and losers, and winners are very few, but the winners do extraordinarily well. Just look at the fortunes of the wealthiest, 5 or 10 people in the United States. Look at their stocks. The wealth, right, of Amazon. And, people have done
Elon Musk.
Right, he's at the top of the list, yeah.
We're getting some questions in. One of them, Adam, it's great to hear you again on Angelo's podcast. You recommended NIO last April. What do you think now?
I'm sorry, NIO?
NIO?
What is that? I don't know what NIO is. I never recommended NIO. I don't even know what it is. What is it?
And while I go to the next question, Kim, if you're still with us and you wanted to type in a little bit more clarity on the acronym, perhaps that would be helpful.
Oh, if it's an acronym, I don't know what NIO, the acronym, stands for.
I did bring up this question earlier, but someone's asking it. I'm going to ask it, and it's a little different perspective. It's a little more negative. Shouldn't we expect the next war will be with China, as they want Taiwan, and the U.S. can't lose access to the semiconductor capital of the world?
Wow. Well, I don't know. Those are difficult speculations, right? Because China, of course, has asserted territorial rights over Taiwan,
Right.
as with Hong Kong, right? And it's unclear really whether the US is in a position to challenge them. Now that's actually like, I don't know how we could challenge that, frankly, really. You know, sending warships there, like how would that play out? You know, and it would destroy any semiconductor industry there, right? It's like
True.
so how could you protect that? The only insurance against that happening is actually in the international community, right? Because if China asserted its territorial claims against Taiwan, and the international community then said, we're like trade embargo with China right now, right? So there are international solutions. I don't see how war, whoa, I hope it doesn't come to that.
A family office is asking, Adam, would you mind mentioning, and this time he's going to write it down, the 3 indicators again, please.
Copper divided by gold. And you could, if you wanted to look at the ETFs, DBB, it's Delta Boy Boy, DBB divided by GLD, right? Those would be the ETFs. LQD divided by IEF. So copper divided by gold is a leading indicator for 10-year yields. LQD divided by IEF, that's the investment grade credit spread. That's probably the single best, tracks the stock market better than anything else, that one right there. And the last one is consumer discretionary divided by consumer staples. So XLY divided by XLP. You might want to use the equal weight ETFs, RCD divided by RHS. So those.
And we did. Thank you. That's very helpful and great advice. The person who asked the question on NIO noted NIO is the Chinese electric car maker, highly touted as a Tesla competitor.
I never recommended NIO or any particular stock. I never did that. I don't know why that person would say that. And so I never, no, I don't know the company even. And I certainly didn't recommend any stock.
What is the life expectancy of the oil complex versus the green movement?
Well, I don't know. I mean, at a certain point, we're going to run out of oil, right? We have to find renewables. That's a for sure. I'm not sure what the question is. It's people have talked about peak oil for some time. And I know that just as a planet, we've got to come up with alternatives. And I'm sure in that respect, technology does really well, right? And there was an economist, his name was Julian Simon, who was really a philosopher. And basically he said, we'll never run out of resources. And I said, what do you mean, Julian? What do you mean he said, a resource is only a resource because human ingenuity has created it. After all, oil was not a resource, 20,000 years ago, because they didn't know how to refine it any more than silicon was, or these rare earths, right? These rare earths are a resource because human ingenuity has created them as a resource. And so Julian Simon's argument was, and by the way, it's very Buffettonian. It is betting on human ingenuity. Human beings get better and better able to do things. What they do is not necessarily a good idea, but they get better able to do things, right? Which is Buffett and Munger's central insight around investing. Why you buy great companies, because great companies will get better and better able to do what it is they're already doing. And that value will increase. So human ingenuity, if you wanted to invest in one thing, invest in human ingenuity. Now, again, that's ingenuity in a tech sense, right? The medical discoveries coming, are just mind-blowing. But we'll cure all diseases in the next 20 years. And as a country, it's just unlivable, right? So the tech part we've got covered. As a species, human beings are really good at knowing how to do things. We just don't know what to do. And so when I think so. So I'm hugely optimistic around tech and, clean tech and, those kinds of investments. Those are, I'm not saying which horse to bet on in that race, but those revolutions are coming, for sure.
Do you think that the winner has already been decided on advanced AI, on quantum? Is it a deep mind, or is it going to come completely out of left field? We don't see it.
I already told you that
the government
labs are way ahead of deep mind. And that's the best, in the US right now. So there are secret labs that are way ahead in terms of AI than anything the commercial companies have right now, like the Jet Propulsion Lab, right? And that's within the States. I think that the trouble is that the developments will come out of nowhere. They'll just be here. Kind of like the Manhattan Project, right? There was no atomic bomb, and then there was. It'll be a very binary thing. Someone will just all of a sudden, whoa, they've got quantum computing. And by the way, when they do, it'll be a lot like that movie with about Turing, right?
Alan Turing, yep.
Right, and figuring out the Enigma machine, right? Mm-hmm. Whoever gets quantum computing first, they're going to keep it a secret for a long time, because basically they're going to have such a huge edge over everybody. Why let people know that you've got this edge now? For all I know, right, quantum computing is already a reality. Like, I don't know. I do know that it's going to be kept a secret for a long time. Just like when we cracked the Enigma code, we didn't tell Germany, hey, you might not want to use that machine anymore, because basically it's an open window for us.
Maybe two final questions from the audience. One came in via text. Adam, I have near a 10% allocation in quant managers. I don't really know what they do, but it appears to be doing well. I don't know if that was meant to be a tongue in cheek, but how would you answer that question? That's more than 1 or 2%, so it's not inconsequential.
Well, quant managers did very badly last year. Really badly. Like, here, AQR, Renaissance Technologies lost 30% last year.
Right, it had a bad year last year.
Well, yeah, and that's a quant strategy. And if your quant strategy can't deal with, so did, with respect, because I know Ray Dalio is dealing with things right now, but, Bridgewater didn't do well last year. And none of the quant funds did. I don't want to say none of them, but none of the majors did, right? Renaissance, awful. AQR, Bridgewater, they all did very badly. So the thing about quant strategies is they're based on we're going to find patterns, and they work as long as the patterns stay stable. But then you discover, and by the way, it's not a coincidence that all the quant funds did badly simultaneously. You can't diversify your way out of it. It's not like Bridgewater did really great and Renaissance did badly. They all did badly. It's just like the summer of 2007. This is before the stock market collapsed in October of that year. But in the summer of 2007, all the quant funds simultaneously lost 10 or 15% in a couple of months. So these quant funds, boy, in Wonderland, I would not want to, I can't give you investment advice, but in Wonderland, this is the Wonderland world. And quant funds did very badly last year as a class.
and it's being a little generalized, but generally I've done surveys, so I see it. My members tend to be active, I would say, VC investors. They're interested in biotech and deep tech.
Mhm.
Uh, and I think it comes down to the quality of the fund. It's really as simple as that. But you may have a perspective, an interesting one that I think my members would like to listen to.
What well, venture capital is different from investing in, say, stocks or something, right? Growth
Yes.
opportunities that you can really do your research and due diligence, not just on the idea, but the team members, right? Who's executing on this idea? And they're really just incredible opportunities where you can spot an opportunity before others do. It's hard to do that in the stock market, right? Buffett and Munger talked about that for years. It's really hard to do what we do because you can find great companies, but you got to pay for them, right? The goal that we do is we try to find a great company at a good price. Hard to find a great company at a great price in the liquid stock market, right? Stock. But at venture capital, you could do that. You could do that. And so yes, I think venture capital is offers more significant returns than traditional. We're just going to have a portfolio of the S&P 500.
True, but you're trading for the illiquidity premium.
Sure, but a family that's got a long time horizon, right, multi-generational, okay, we'll deal with a little illiquidity. And there are certain plays where the exits are pretty clear. Like in the consumer space, especially consumer and food, the exits are real clear because these startups get sold for incredible multiples to major conglomerates who can't do the kind of innovating in the consumer space. So really, venture capital in the consumer space, wow, is a pretty clear path. If someone said, Adam, you could only invest in one area, I'd say I would do venture capital in that space because I know the exit is to sell it to a conglomerate because conglomerates can't innovate in the consumer space.
And Adam, as we conclude, and unless things changed on your website for Robinson Global Strategies, you don't necessarily, like a lot of the thinkers in the community, sign up for this, and then we have levels. We try to sell you this level, that level, that level. For those families who are qualified that want to go on your website and learn more.
Well, they're not going to find anything. It's not like I'm
there's not much.
Clients. No, I'm not. And I've got my hands full. And if they have specific questions about what to do, I'd be glad to share some insights. But I have my hands full. So I mean, I always thank you for that. I know you're a big fan of my work, and by the way, that's why I give value to you and your family members. I give away a lot of really key, valuable insights. Those things that I gave away, whoa, you could do very well with that information that I gave you. And so it's to empower people to do better in the world. I'm doing just fine. And I have my clients and other ventures.
That's incredible to hear. And I always appreciate your amazing ideas, how willing and sharing you are with them. And look at this, about 2 hours and 15 minutes in, you're incredibly generous with your time. I greatly appreciate it. In my conclusion, everyone, I'm Angelo Robles, host of the Angelo Robles Podcast and founder and CEO at Family Office Association, a global membership organization dedicated to families of wealth and their family offices. You heard tonight from Adam, where we covered so many topics. It is not just the big macro picture or investing. It's the issues that we spoke about, from a issue with our society, with looking forward with the challenges of AI, We gave a little conversation to universal base income. Again, something that makes many of us, including me a couple of years ago, feel very queasy. But in looking at the long-term trends, just lots of deep issues. So imagine being part of a membership organization where you have like-minded peers around the world, highly successful people, and they're intelligent, I hope, family offices, and the opportunity to interact, benchmarking best practices and sharing ideas. That really gets at the heart of who we are. And you can learn more by going to familyofficeassociation.com and looking into membership. It's very easy. And my direct email is angelo@familyofficeassociation.com. I'm also very active on social media. Lately, my preferred medium is YouTube. You could find me or us at Family Office. And I also have, I'm very fortunate, a very fast growing on Apple, Spotify, and other platforms podcast, I believe, simply called the Angelo Robles Podcast. Adam, I appreciate your time again so much.
Well, thank you. It's always it's a rich experience being in conversation with you. Your questions are provocative and some of them speculative. And I, said, I don't want to think about that because it's not going to help me or your family members navigate the world right now. And there's enough to think about, right? And by the way, I think that's one of the great benefits of your association is bringing family offices together and really think through these things. These are really challenging times at a crisis level that people don't fully appreciate, and one of great opportunity, right, for those who see clearly what's going on and invest accordingly.
Great closing comments, and I appreciate your kind words, Adam. I look forward to next time. Thank you.